Welcome back to Hard Money Jim, where we're all about money creation and its consequences. I'm an advocate of owning gold as a key part of a savings and investment portfolio, especially during these times of profligate government spending, increasing government debt, and the inevitable monetization of that debt. And gold, along with its closest monetary relative, silver, provides the best protection I know to safeguard your wealth against the depreciating purchasing power of fiat money. But no investment is without risk. It would be irresponsible to advocate owning gold without pointing out the associated risks. So if you're going to own precious metals, you should do so with your eyes wide open. And so that's what I want to do today. And in preview, what we're going to see today is that yes, gold and silver definitely have their risks, but these risks are very different from those of other investments. And as we'll see, the fact that these risks are not highly correlated to the risks of investing in stocks and bonds works to the investor's advantage over the long run. Before we get going, a couple of housekeeping items. First, this video is not personal investment advice. As usual, you should do your homework and consult an investment advisor before committing any money to these volatile markets. And second, if you think this information is useful, please hit the subscribe button below, as this will help get the word out on the negative consequences of excessive money creation and what you can do to counter those consequences and preserve and grow your wealth. There are basically three risks to owning gold, and these apply to silver as well. So for convenience today, I'm going to just talk about gold, but almost everything I say also applies to silver. Gold's three principal risks are theft risk, government risk, and price risk. And let's talk about all three in turn. First, there is the risk of theft or pilferage. I recommend buying physical gold and storing it in a secure location, such as a safe or a safe deposit box or a bonded warehouse. You need to take prudent and reasonable precautions to reduce the chance of loss due to theft. By contrast, your digital or paper investments, like your bank deposit, stocks, and bonds, are less vulnerable to physical theft, but they face the risk of fraud or what we call fidelity loss, possibly through cyber theft, for example. So physical gold is not susceptible to fraud or fidelity risk, but there is always a very small chance of physical theft. No investment I know is completely immune to both theft and fidelity risk, although smart precautions or private insurance can reduce these risks to a very low level. But the fact is that owning physical gold, it does not really have to be risky. When you own small amounts of gold, you can keep it hidden in a locked file drawer. Larger but still moderate amounts should probably be stored in a family safe or a safe deposit box, or both, along with your important documents or precious family heirlooms. And later, when your metal holdings become more significant, you can store it in a bonded, insured warehouse, and no one but you and perhaps one or two trusted family members or friends has to know you have it. So actual financial losses coming from the theft of gold, especially if you use, a respected gold depository, are very rare. For example, the Texas Bullion Depository near Austin has Fort Knox level security. And there are at least 13 other high security depositories located around the USA. And it's easy to search online for locations and services that they provide. So bottom line, the risk of theft associated with the physical storage of gold is in truth just a minor inconvenience in my view. Second risk, there is what I call government or legal risk. And frankly, this is what most people I talk to worry about. They worry that the U.S. government confiscated gold in 1933 and might do so again. You could say this is the risk of theft by the government. So let's address this question. Can gold be outlawed or confiscated? Of all the risks associated with owning gold, this one is perceived by most people to be the most important. And I run into this question all the time, and it's the most asked question that was asked after my viral gold video a few weeks ago called The Great Reset, which aired a couple of weeks ago. And if you haven't seen that one, by the way, please check it out and subscribe. But anyway, the risk of government confiscation is a reasonable concern, and we should consider it in some detail. After all, the USA seized and outlawed most privately owned gold in 1933, so why couldn't they do it again? Why couldn't it happen again? My view on this is that confiscation or a government restriction on ownership is possible, but the risk is greatly exaggerated, and in reality, the risk is very low. I don't say that it could never happen again, but I want to tell you why I think confiscation of your gold by the government is highly unlikely. So to get to this, let's briefly go through the history of the gold confiscation of 1933 and its subsequent re-legalization in the USA. In 1933, Franklin Delano Roosevelt, president, by executive order, made U.S. citizens surrender their gold, except for small amounts, and the government paid them for this gold at $20.67 per ounce. The title of the executive order was Executive Order 6102, quote, requiring gold coin, gold bullion, and gold certificates to be delivered to the president. It was signed by Franklin Roosevelt. The legal basis for it at the time was the Trading with the Enemy Act, later amended in March 1933 by the Emergency Banking Act. And these acts granted the president broad powers during national emergencies. The core provisions of the executive order were that all persons and private legal entities were required to deliver all gold coin, gold bullion, and gold certificates to a Federal Reserve Bank or a member bank by May 1st, 1933. But they were compensated at a rate of $20.67 per ounce, which was the official gold standard price at the time. There were some exceptions to this confiscation. You could keep gold for industrial or professional or artistic use. You could keep some jewelry. You could keep some rare and unusual coins with recognized collectible value. And of course, gold held by foreign governments did not have to be surrendered. There were severe penalties for not complying with this take-up. You could get up to 10 years in prison and or a $10,000 fine, which would be equivalent to $240,000 today. And willful violations could lead to gold forfeiture. In a later act, the 1934 Act, Congress also prohibited gold clauses in contracts that would require payment in gold. So the important point is that this 1933 gold grab by the government was not really a full-blown confiscation because gold owners were compensated at $20.67 per ounce. So as I mentioned, a year later in 1934, Congress passed this, what they called the Gold Reserve Act, requiring the Fed to give all its gold to the Treasury. And this act fixed the value of gold held by foreign banks at $35 per ounce, but U.S. private citizens were not allowed to own it. The Gold Reserve Act was the legislation that formally took the USA off the domestic gold standard, and it was a major default on a government promise and a major devaluation of the currency. However, the U.S. government was still going to redeem foreign-held U.S. dollars for gold at a new price of $35 per ounce. For example, if the Bank of England held dollars that had accumulated in English banks due to British export surpluses to the USA, the Bank of England could demand and receive payment in gold from the U.S. in exchange for those dollars. And this new system, known as an international gold exchange standard, remained in effect for almost 40 years. But in 1971, President Richard Nixon, by executive order, announced that the U.S. would no longer convert foreign dollars to gold. And this was the final demise of the international gold standard. I would say, ironically, it also set the stage for the renewal of legal gold ownership by citizens by severing gold from all official fiat money. And this move was another major devaluation of sorts of the dollar. And its intent was to render gold a mere collectible, like a pet rock, in favor of fiat money. However, following this devaluation, there was a shift in thinking in the country, a movement away from the leftist sentiment of the 1930s. By the early 1970s, monetarists and libertarians were arguing that gold ownership was a basic property right, even for individual citizens. So in 1974, President Gerald Ford rescinded FDR's 1933 executive order. Why does this matter? Because next, Congress passed Public Law 93-373, where they voted overwhelmingly, 381 to 33, in the House, for example, to kill the ban on gold forever. And they formalized it by legislation. And at midnight on December 31st, 1974, gold shops opened back up again in New York and Chicago and Los Angeles, and the lines wrapped around the block for people to go buy their gold. This bill was sponsored by Representative Philip M. Crane, Republican from Illinois, and we should remember his positive influence there, and it was supported by famous economists like Milton Friedman. The bill formally decriminalized private gold ownership of gold bullion and coins, and the gold price soared to $180 per ounce in 1975. Then in 1977, Congress passed Public Law 95-147, where Congress removed the president's authority to regulate gold under any circumstance, except declared war. And this bill again passed with a large margin and was overwhelmingly bipartisan. The bill was signed into law by President Jimmy Carter in October 1977 and went into effect immediately. In 1985, we then had the Gold Bullion Coin Act, which is Public Law 99-185. This was the law that restored the U.S. Mint's ability to mint and sell gold coins for the first time in 52 years. So that's kind of a long-winded encapsulation, and I'm trying to show the strong legal precedent that's been established in the last 50 plus years that restored gold ownership. And my point is, it would take a very oppressive and unpopular move by the government to take this away from the people. And note that the right to own gold was restored not merely by presidential executive order, but by legislation, overwhelmingly passed legislation. So I think it would be hard for a president to try to override Congress on this. And it would also be an admission of complete failure of fiat money, which would then further undermine the value of the fiat dollar. It would be very, very unpopular, or worse in my view. And by law, any confiscation of gold, by executive order, would have to be in a time of declared war. But there's even more than just the obstacle of undoing existing law. In addition to this existing federal legislation and the precedents and the popularity of gold, most of the individual United States over the last several years have been gradually and actively adopting laws that encourage gold ownership. For example, as of November 2025, 46 states have fully eliminated sales tax on gold and silver bullion and coins, and only 4 states still tax these as ordinary goods. And this is important because sales tax used to add 6 to 10% in economic friction. Removing it treats gold more like money and less as a commodity or as a collectible, and thus it encourages trading in gold and silver. Now, another 13 states have gone further and declared gold and silver legal tender for everyday debts, taxes, and voluntary transactions. There were 5 brand new legal tender laws in 2025 alone. I'm going to show you what is now legal tender. Hold it up right here, is called an ARM. Actually, it's known in Utah as a goldback. This is 1/1000th of an ounce of gold impregnated into a plastic bill. And it's got inside it 1/1000th of a troy ounce of gold. So it's worth about $4 at today's gold price. Here's another one. There we go. This is worth about $13 at today's price of $4,000 per ounce. This constitutes about, what is this? 1 milligram of gold. So that's actually legal tender. And these legal tender laws allow you to pay state taxes, fees, private debts in gold and silver coins or these things. You can use these things. And they require courts to accept specific performance on contracts payable in specie, that is gold and silver. These laws allow you to use applications like Glint and Goldback to spend your gold electronically. You can avoid state capital gains tax, which have been repealed in 13 states, where there's no state tax on capital gains when you transact in gold. And some states are setting up gold reserves to bolster their state finances. Wyoming, for example, where I live, is one example, and Idaho is studying the idea. And these states also have banned central bank digital currencies. 8 states explicitly reject the legality of central bank digital currency, refusing to recognize it as money. So yes, many individual states are making it easier to own and spend gold. So if the executive branch of the Congress tried to outlaw it, they would certainly get resistance from states like Texas and Utah and Wyoming and many others who have been encouraging gold ownership. So to sum up this point on government risk, for all these reasons, the historical congressional legislation, the state support of gold ownership, and the popularity of owning gold, I think it's very unlikely that either the president or the Congress would try to take your gold away from you. So now we've discussed the theft risk and the legal risk. There is one other obvious risk I think we should deal with in owning gold, and that is what I'm going to call pricing risk. To put it concretely and simply, the gold price in dollars can vary a lot over the short and intermediate term. So if you have to sell your gold to get dollars, the risk is you could lose money. For example, if you'd bought gold at its recent peak price a few weeks ago at about, at around $4,350 per ounce, and then had to sell it today, you'd probably get about $4,000 for that same ounce, although I notice gold's up above $4,100 again today. But let's just say it's $4,000, which would mean you lost about maybe 8% of your cash value. Even over longer time periods, you might get back in dollars less than you paid for it. For example, if you'd bought gold at its interim peak of around $800 per ounce back in 1980, you'd have waited over 20 years for the gold price to reach that price again. If you had bought gold at other interim peaks, as in 2011, you might have waited 4 years or more to break even. Now, of course, a very similar pattern emerges for stocks. There are numerous historical cases of bear markets in stocks that last for well over 10 years. However, I want to point out, practically no one saves and invests this way. With both gold and stocks, most people will sort of mitigate the downside price risk by investing regularly, whether the price is rising or falling. Sometimes we call that dollar cost averaging. And this allows you to lessen the impact of the most extreme movements in the price. But nevertheless, the pricing risk in gold is similar to stocks in that the dollar price of both gold and stocks have fluctuated over time, with generally an upward trend. But in both cases, the general upward trend is caused by the inflation of the money supply, but this upward movement is never a predictable line. However, there's an important difference between the timing of the price fluctuations in stocks compared to the price fluctuations in gold. So now let's talk about gold as a diversifying element or a source of variation in an investment portfolio. What I want to show now is why a portfolio of stocks combined with gold is less volatile and therefore less risky than a portfolio of stocks only or gold only. And this is because the price movements of gold are not highly correlated with the price of stocks. Now, here are some charts of the price of gold and the price of the Standard & Poor's 500 index since 1971. So here's gold price in US dollars per troy ounce, 1971 to November 7th, 2025. And here is the S&P 500 total return index with dividends reinvested from 1971 to November 8th, 2025. And you can see both move in a long-term upward trend. And at first glance, they look pretty similar. But when you look closer, the fact is that when the price of one rises, the other tends to fall, and vice versa. This non-correlation works to the investor's advantage, allowing you to maintain high investment returns while reducing the variability or volatility of those returns. And given this favorable combination, I'm surprised that more traditional investment advisors don't recommend gold as a non-correlated diversifier in a growth portfolio. Given the rising popularity of gold, I suspect more of them will start doing this in the near future. Okay, so let's look now at this very interesting chart that I asked Grok to construct for me. I asked Grok for some help in assembling a 30-year total return chart, and I started in 1995 simply because it's 30 years ago, and I consider 30 years of saving and investing to be a normal time horizon for a rational financial planner. And let me explain this chart. I started with 1 ounce of gold in January 1995, which at that time was priced at $384 per ounce. That's the yellow line. I invested this ounce of gold at 3% annual interest paid in gold. So what that means is in year one, you earn interest on 1 ounce. In year two, you earn 3% interest on 1.03 ounces. In year three, you earn 3% interest on 1.061 ounces. So it's simple compounding, a simple compounding function. Year four, you earn 3% on 1.0927 ounces and so on. You go on doing that for 31 years. At the end of 31 years, you've accumulated 2.5 ounces of gold. And of course, the dollar price of gold is always changing with an upward bias over time. So in today's dollars and at today's gold price, your 2.5 ounces of gold is worth over $10,000. So your gold grew from 1 ounce to 2.5 ounces, and your dollars grew from $384 to $10,000. Now, this is hypothetical because you probably could not have earned interest on your gold paid in gold for that entire period. But today, and for about the last 8 years, you can do this. It is possible through a company called Monetary Metals and Company. So it's no longer hypothetical to earn interest on gold paid in gold, which is why I assumed 3% annual rate of return. But I'll have more to say about monetary metals later. But anyway, the yellow line shows how this 1 ounce of gold would have performed in dollars if you could have invested it at 3% with interest paid in gold. The blue line illustrates the investment of the same initial amount of $384 invested in the S&P 500 total return index, which is a broad index of the largest U.S. publicly traded companies. Once again, it would not have been possible to perfectly match the performance of this index over this 31-year period. So I'm conducting this exercise to compare returns on stocks with returns on gold. So I have to use these hypothetical benchmarks, which will accurately compare the investment characteristic of one asset versus the other, even though they are not actual real historical returns. Anyway, what does this mental experiment show? Well, first it shows that over this 30-plus year period, gold that earned a modest 3% rate of interest performed competitively with stocks. 1 ounce of gold earning 3% compounded to a little over $10,000 because of price changes in the gold, yielding an average compound annual return of 11.1% measured in dollars. An equal amount of money invested in stocks gave you an average compound return over the same period of 10.8%. So that's almost equal performance. I will say there's some small advantage to the stocks, in my view, just based on this comparison, because if you had to cash out something, sometime along the way, or sell part of it, you could always sell either your stocks or your gold, but it's somewhat more convenient to sell stocks typically, as it is very easy to use, our electronic trading systems, and you can have your money quickly. While that option doesn't really exist for gold bullion, it's very liquid, but it might take you a few days to, sell it. So given that the aggregate performance of gold earning 3% and stocks is nearly the same, but stocks are more convenient to sell if you need cash, the question is, why would you even bother with owning gold? So for the answer, let's look closely at that chart again. The red line represents a portfolio of 50% gold and 50% stocks. And this combined portfolio yields an average return of 10.95%. Again, nearly identical performance. But let's now look at some of the volatile periods to understand the advantage of adding gold to your investments. So in 1995, the Standard & Poor's 500 went way up and gold lagged behind. The 50-50 red portfolio lagged slightly, but it was still strong. In 2000 to 2002, during the dot-com crash, the S&P 500 crashed 38%. Gold was up 3%. And the 50-50 portfolio strongly outperformed the S&P 500. In other words, there was less volatility and less stress on you, the investor. From 2003 to 2007, you had a strong equity recovery, but gold also rose during that period with inflation fears. The 50-50 portfolio did very well, but it did slightly underperform pure stocks. Now then in 2008, you had the great financial crisis and another big crash. The S&P crashed 37%, but gold went up 19%, up 19%. So the 50-50 portfolio was down, but only by 10%. Again, less volatility and less stress. And then these interesting years from 2009 to 2021, these were the Fed's 12 years of aggressive quantitative easing on an unprecedented level of money printing, resulting in a powerful bull market in stocks. And this was a period when the combined portfolio really showed its value. You can see that the red line smooths out the volatility in both gold and stocks, especially around the time of the COVID-related 2020 market crash. In 2022, there was a brief but scary dual drawdown. Gold earning 3% was down slightly, while the S&P 500 was down 18%, but the 50-50 portfolio was down a much more palatable 9%. Now in 2023 and up to today in 2025, we are in an AI-led stock rally. We're still in this as of today. And the S&P 500 has surged, but the 50-50 portfolio nearly catches up in 2024. And in 2025, gold has surged by over 50%, while the S&P 500 has moved up about 20%. Both of those, by the way, are abnormally high upward moves. But you could see that the combined portfolio has done quite well. Well, the bottom line from this analysis for this last 30 years is that from 1995 to 2025 year to date, the return on pure stocks versus pure gold earning 3%, those returns were virtually the same, but the 50-50 portfolio gave you nearly all the upside with much less pain from volatility. We can say, I think, that adding gold to the portfolio provides lower volatility, better protection during crashes like 2002, 2008 to 12, and 2020. We can say that gold alone underperforms in a low inflation, high growth era, but gold outperforms stocks in periods of great uncertainty, growing debt, and money printing. Let me quote from a recent Financial Times article on gold's ability to hedge or sort of de-risk a stock portfolio. This is an excellent recent article in the FT, which pointed out that gold is a good hedge against a decline in stock prices, but you have to be patient. The reason is that when equity prices decline, many equity owners need to raise cash to meet margin calls. And for a time, gold gets caught up in this sell-off because when you get a margin call, you sell what you can, not necessarily what you would like to sell. And gold is always liquid and can always be sold for cash. Gold does sell off in these times of stress initially, but then in a few weeks or months, gold starts to outperform equity. And let me quote the FT article. Quote, looking at the past 6 instances where the S&P 500 fell by 15% or more, gold prices initially declined as well. By the time the S&P 500 troughed, however, gold had outperformed by a noteworthy average of 40 percentage points and with absolute positive returns in 4 of the 6 instances. What's important to know is that these gold price pullbacks usually proved less extreme than those in equities, both in degree and duration. Today, Conditions appear to be building for a repeat of this historical pattern in which gold might see a period of negative returns before once again showing its diversification ability. Such risk seems relatively more likely after a run-up in gold prices of more than 57% this year alone, including the recent sell-off. But even if some of the shine wears off gold in this potential scenario, there is good reason to expect the price decline will once again be shorter and less steep than that in risk assets. So let's wrap up these points on the pricing risk inherent in gold. What this analysis shows is that you can use the price risk of gold to actually reduce the price risk of your overall portfolio. And this fact makes gold's non-correlation with other asset classes a very valuable diversifier in my view. Now, there are also other portfolio advantages to gold that few people ever talk about. I said at the beginning that every investment carries some kind of risk, but what about the opposite side of that coin? What about the risks you do not take by owning gold? Let's talk about that now. This is going to answer a question I received from a reader. I've gotten this from several readers actually, who said they might be uncomfortable with owning and storing high value items like physical gold. And my answer is yes. You do have to deal with, that inconvenience of secure physical storage, but there are risks to owning anything that is valuable. And you always have to assess all the known risks and balance them. So I think the right question to ask is, what about the risks you do not face, you do not take by owning gold? In other words, the risks you can avoid by owning gold. Here is an extended quote from Michael Weeks of Edelweiss Holdings. He says, "What makes gold compelling are the risks we don't take by owning it. No forecasting or guesswork is required. The risks we don't take owning gold could fill volumes. With gold, there's no duration risk, credit risk, or liquidity risk. The metal is not moved by financial instability, nor threatened by national insolvency or chaos in foreign exchange markets. There are no margin calls and no refinancing risk. There's no risk of technological obsolescence, depletion, depreciation, or decay, nor does it require cheap energy, cheap credit, or cheap trade to remain viable. Gold doesn't care about your national energy policy or who you buy your gas from or how many pipelines are running. You don't have to keep the lights on or even keep it warm. There are no financial accounts to pour over, no balance sheet to blow up, no cash flows to dwindle, no stale inventory, and no margin pressures in difficult times. There are no key man or supplier risks, no competitive risks, no management to squander its future. Gold does not depend on the character, skill, or enthusiasm of anyone. It doesn't require the faith or goodwill of others. It doesn't require you to trust anyone at all." Now, Michael Weeks then goes on to talk about his firm's overall investment philosophy, which I think is wise and which I try to live up to. He says, quote, "The absence of unwanted risks is the center of our investment approach. This principle applies to our choice of gold reserves as well as the business participations that we hold. Both parts are brought together by seeking to avoid the risks that aren't worth taking, and by extension, having the freedom to choose the risks worth embracing. We play the long game, but we are keenly interested in the kind of opportunity that makes sense through our own prism of what is valuable and worth possessing." I could not have said that better. I have one more quick quote from a well-known gold investor named James Aitken. In helping people think about an investment decision, there are three choices: buy it, sell it, and the third, which is so often overlooked, do nothing. If you own gold as a liquidity reserve or a store of value, you have the luxury of being able to do nothing in periods of great upheaval. So this is why I say, at a minimum, buy some physical gold and then do nothing with it. Remember where it is and store it safely, but forget you have it. Live without it. Most people will not do this, but I believe many will someday wish they had. Now, you can go beyond this minimum advice by saving regularly in gold and silver and earning interest on it to add to your accumulation over time. This is the website for Monetary Metals and Company. Now, if you're interested in this unique way to save and accumulate gold or silver, you can investigate the Monetary Metals and Company website. We are the only firm I know which pays interest on gold or silver, paid in gold or silver. In full disclosure, I sit on the board of directors at Monetary Metals. I invest in gold and silver with them, and I'm also an equity owner, an equity investor, a minor one, in the firm. But I can also tell you that even if I were not an investor in the firm, I would still be a client, and I receive no compensation from the firm for talking about their services. So check out their website and decide for yourself if this is for you, if earning interest on your precious metal with interest paid in that same precious metal is something you want to know more about. At present, most of our lease opportunities are earning 4% net to the investor, and the bonds pay an even higher rate. Okay, in future videos, I'm going to explain how that works, how we are able to pay interest on gold in gold. It's really pretty simple, but that's really all the time we have for today. So thanks for watching. Be careful out there, and we will chat again soon.